Good evening, ladies and gentlemen. This is Clueless 8 Trading Frank. This is the end of the week. More importantly, a start of the of next week's and the following till the middle of the month report videocast. And I'm going to go scroll through a whole bunch of charts, which I show repeatedly anyway on the real-time Twitter feed. But I'll put in my 2 cents on what I think might be going on. First and foremost, we have futures slightly down. They were down quite a bit more earlier on the referendum in Italy, where the opposition parties basically they won the referendum. Prime Minister Renzi is going to resign. I believe the markets had somewhat expected that. That's why we're seeing a muted reaction. Whichever the case, it's not necessarily a good thing when it comes to financial markets. Not talking about the political stuff, and it could be sort of taken as somewhat negative. We'll see how it pans out. The Austrian vote went towards the center-left candidate, so the far-right opposition populist candidate did not win, so it did not pan out like Italy did. Whichever the case, let's take a look at the technicals because that's really what matters to us. So I'm going to scroll through a bunch of charts in this 20-minute broadcast, and so just pay some attention. First and foremost, this is a chart of the S&P 500. The multi-year breakout level was somewhere here at around the 2115 level, which we attempted and then finally broke out of back right after the July 4th weekend. Right here, you can see the date down here on July 7th, 2008. Right? We went powerful up. And a power surge, and then eased back a little bit, then another power surge, kind of vacillated around, heavy volatility, tried to get back up towards the highs, which was the 2016 highs at around the 2195 level, and then we had Brexit, right? I'm sorry, this was not Brexit. My apologies. This was Brexit. This was the fallout back in the first part of September, and that was a pretty sharp drop. We vacillated around all kinds of volatility moves, tried to get back towards claiming the 2190 level, failed again, vacillated around, then had a big drop. All the nervousness ahead of the elections. Back in October, and then we had our own version of what I call Trexit, the Trump exit, which we all know by now. We were way further down after hours, and then reversed up, opened up the following day, and then never looked back so far, right? Just the way it happened. So seeing chart patterns is extremely important because it gives you a perspective on pattern symmetry and all kinds of different stuff that happens, because like I always said before, and I say it again, every crisis is the same for different reasons. So the bottom line is there are many different crises, world crises that we have gone through, and the markets have all kind of reacted in the same way. All right? So it's not like, it's something new. So if you look at every single pattern that's occurred, and this was the big fallout back in January and February, which most of you have forgotten by now, and then we had a massive dragon bullish formation, the W formation, and massive move up, massive. I mean, this is humongous. And then you had the Brexit, similar type of thing. Remember, it's always the first huge 3-candle move, then the market sort of softens up a little bit. In this case, it went higher, and look where we are now. So let's zoom in to see what's going on right now. So we had this big massive move, at least from the bottom, from the 20, it was actually lower, more like around 2040 or so. And we went and made a new high. And that high was projected on my previous charts. Feel free to go back and review my broadcast, my videocast, which was around, I predicted, and this is the E-minis that we're looking at. So you have to add a couple of points to it. We went as high as 2213, which is roughly on the S&P 500. We went as high as 2214. So again, so we were up here. So now we are in a consolidation phase, minor, okay? And the way it works, and again, if you want to know the exact specific ways of looking at this and calculating it and arriving at a number, you have to take the advanced coaching sessions. People who have taken it, ask them. and they're pretty much experts at figuring these things out. Not that it's going to all happen within the exact 5 minutes of when we say it's going to happen, but we are right now in a consolidation channel, and that consolidation channel has some very strong supports. One is this breakout level here. That was a breakout from September 22nd, and then we broke out here again on November 17th, and test of the breakout level is almost mandatory. That's roughly at around 2179 on the E-minis. So you're talking about roughly about 2182 or so on the S&P 500. Okay, that also coincides with this red line here, which is a mid-Bollinger. These are Bollinger Bands, and in the mid-Bollinger we are looking at, again, pretty much at the same level, around 2180 or so. Below 2180 on the S&P 500, things start to get a little bit nutty. Okay, because at that point, what comes into play, trying to find those lovely crayons that I use here, but I can't seem to find them today. Anyway, my apologies. So what happens is, after this, you have a mini trend change, and that means that we could possibly come down and test this very, very powerful downtrend line, which was broken. You can see that on which is actually broken on the 11th of September 2016. I'm sorry, 9th of November 2016. And a retest of that line is still in the cards. Now, that's quite a bit of a drop. That's down towards the 2130, 2140 level in the S&P 500. People are going to start freaking out if they are heavily long. So it's good to be tactical, and you can make a substantial amount of money if you catch that wave down. Now, do I think that wave is going to happen right away? I don't think so, but I've seen weirder things happen in the market, you know? That's why we try to, make head or tail out of the markets by looking at some probabilities scenarios rather than certainty scenarios, which some gurus out there seem to think they know it all. They are all lying, in my opinion. It's a game of probabilities, not a game of certainties. So what I'm showing you is the probabilities of what might happen. Keep in mind, we're in the first week of December, which generally bullish, because that's when the new money comes into the market and all such things. But at the same time, the difference is that the new money coming in from pension funds and mutual funds, they're mandated to put new cash into the market. The thing is that we have run up so much into the beginning of December. We also have a couple of things to keep in mind. We have tax harvesting, tax loss selling and such that happen in the month of December, and that's something that we encounter generally in the first part of December. So the first part of December, which encompasses the Federal Reserve meeting on December 15th, which is very, very critical, probably the most important meeting on Federal Reserve history in recent memory, because they are going to raise rates from what it looks like. There's going to be nervousness, right? And so the first part of December gets very choppy. I still believe we're going to have a real blast up on the market, where we're going to test out the highs and possibly overshoot the numbers that are thrown around. And looking at the charts, I'll be showing you the S&P 500 also on the Thinkorswim platform. You can see that we have the upper Bollinger here. We have this rising wedge formation, right? Upper here at 2224. So we could go as high as 2240, even 2250 on the S&P 500. And that can happen. A couple of 100 points higher from here. But before that, you need a consolidation. That's what I'm talking about. And the consolidation can be very, very lucrative. And given the fact that we are right now, and I'll show this on the S&P chart, we have overshot quite a bit on a short-term basis. So you need a reset. So this is where we are right now. So these levels, when I show you on the chart, you can print out the chart on your printer or take a screenshot on your screen so you can always refer back to it. Or, more importantly, you can set it up on investing.com using the same lines. You need some help, maybe you can reach out to me if I have time. I'm certainly going to help you out. All right, it's very, very important that you monitor the charts on your own screen, because you cannot rely on me every single minute on trying to the ever-changing market landscape that comes about, right? So you got this. These are all uptrend lines. This is a massive uptrend line from the which is all the way down here. But this is what I'm looking at. I'm looking at a retest of the mid Bollinger, which is roughly around 2180 or so in the S&P 500. Any slippage will bring us to testing, and I'll show you another level here, which was the breakout level. There you go. See that? And that I am going to There you go. Okay, so that was another breakout level that we broke out of on when we broke out of this big downtrend line back on around the 11th of, I'm sorry, the 9th of November. And that breakout line comes to roughly around 2160 or so on the S&P 500. So those possibilities are still there, and we could get that. In fact, if we get a sharp pullback on the first part of December, it sets us up for a nice rally towards the latter part of the year, latter part of December, what we call the Santa rally, right? So here is the actual chart of the S&P 500, right? The static chart. You have the moving averages, which are starting to cross over, very bullish. This orange line is the 34-day moving average crossing over the red line here. What I would like to see is this particular red line actually start to turn up, right? And that would be helpful, because when you start turning up, like you had a crossover here, and the red 50-day moving average actually started to accelerate higher, that's when you get the real juice. So that worries me a little bit, that the fact that the 50-day moving average is somewhat flat and the 34 moving average is going over this. And again, given the ferocity of in financials, in energy, I just can't, I really can't give you reasoning. Maybe the fact that utilities and dividend paying stocks got hit really bad as rates are rising very, very rapidly. I've showed that on the 10-year chart known as the TNX, 10-year bill. Maybe that's what's slowing down the rate of rise of the 50 moving average. But we need to have the 50-day moving average starting to move up, or else things are going to, or else it's going to be higher lows, lower highs, and then the market's going to drop. So here is a very defined chart. It's very easy to see. You have levels here, 2180, a retest of the 50 and the 34-day moving average brings us to 2158. That correlates with the 2160 that I just talked about. Now, let me stop for a second here. Some of you who are new wondering, why is he talking about the S&P so much? It's not that important. I own Amazon, I own this, that, that's what they're telling themselves. Well, every single thing that you own is held hostage to what the S&P 500, NASDAQ 100, Russell 2000 are doing. So if you're not really focusing on the background where the kabuki actors are, right? On the kabuki stage where the actors are waiting to come out on the wings. That's the S&P 500, the E-minis, the S&P 500 and such. So if you don't quite understand that, you will never be able to manage your trades. So just by focusing on prices on individual stocks is a losing game. You have to understand what's happening in the backdrop, because if you don't understand that, then you're in deep trouble, period. And you guys all, people who have been with my service know that extremely well. I am not asking you to become a futures player. I'm not asking you to become a complete expert on understanding S&P 500 movements and E-minis and such. But I am asking you to at least understand the basic levels that I keep on putting out there, so you can manage your trades on an intraday basis, intra-week basis, and such. Okay, got 7 minutes left on this video cast, so I got to be quick. So, so the bottom line is that you have, I'll actually do another 20 minutes showing you some other indicators, because I think that's important to see. I won't be able to fit that in within the 7 minutes that's left on this session. Okay, so you got all these levels here. So when I show you these charts, these are not for fun and games. These are things that you have to, concentrate on. The other thing I'm noticing, well, I showed you the flattening of the 50-day, which I don't particularly like. I needed to accelerate higher, is the fact that look what happened last time. You had the market move up, big 3-candle move, right? 1, 2, 3 off Brexit. I showed this pattern. I said take advantage of it. Many of you did. Good for you all. Then you start to see the market make another leg up. Well, we had the 3-candle move, minor consolidation, and then we had another leg up. So look what happens in the stages where the Bollinger Bands are speeding up. There's a lot of things on this chart, by the way. You got the stochastics, you got the McLaren oscillators, blah, blah, blah. But let me focus on the patterns here. So you got this acceleration of this crossover, which we're not seeing yet. Keep in mind, that to me is a warning sign. And then the market basically goes into this chop, 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 chop volatility move. Every day you wake up, you're like, where's the breakout? Where's the breakout? Or where's the breakdown? Well, it ain't happening. It's chop central. So we might be entering a period which, in my opinion, is going to be chop central for the first part of December. Okay? And this is a consolidation megaphone. Lower end of the consolidation fits exactly with the mid Bollinger 2177, 2180. If you can make yourself, and we closed at around 2192, right? So tactically, you can make yourself 10 points or so on the S&P puts by tactically playing the market. Now, this is a daily chart, right? The other thing that's happening on the stochastics is it is resetting. This is a reset in progress. Resets generally come down here, and those are very optimal times to buy, as you all know by now. People who have been with my service, and those resets are, stochastics go down to about negative point. In this case, it was 0.98. You can go down to 0, and then basically, when you start to turn, you get this big blast. Every single time, stochastics have basically come down below the 20 line, this is the second derivative of the RSI, right? So 20 is sort of, you buy below 20 and you sell above 80. That's the general rule of the thumb. And so that's exactly what it's doing. When it gets this choppy and volatile, that's when you have to manage your trades like a hawk intraday. You cannot be sitting there hoping and wishing. So we might be getting into a stage where we move sideways and lots of chop in the intraday. And I've been noticing, because of the bifurcation and the sector rotation between the financials and the techs and the biotechs, acting all weird, the price movements. And I talked about this on some ACS sessions this weekend, private ACS sessions that I do with some terrific people who have signed up, that the choppiness in the price is bothersome, because it seems like the algos are being held hostage to bigger forces, such as institutional margin sellouts, all kinds of movements within institutional hedge funds, end of the year shenanigans, all kinds of stuff. And it's bothersome, because when prices move up 5, then down 4, then up 3, and then flat, you don't have a consistent move. So unless you're a really fast trader, you don't want to do it. You're going to lose money, period. Because no one can be as fast as the machines. It doesn't matter what they say. But you get a nice little swing up, like a Chipotle going up like $6, $7, $8 one day. You can certainly take advantage of those. But you look at the Amazons as it's coming down to levels which are starting to look, at least on a technical basis, cheap. A little bit more to go, in my opinion. It's very hard to manage those trades. Yet intraday, you could make money. And again, then on top of that, you got stuff like Netflix, which I've shown the chart repeatedly. It's moving into a channel. Looks like 124 is where it wants to go, and that's acting very well. So volatility is very tricky. And it's not something that you can basically package in a lovely gift package and give to grandma and say, "Hi, this is a lovely present." Volatility in itself is a pain in the butt. We all know that, right? And especially intraday volatility. So this chart is very clean. The other thing to keep in mind, that once we busted loose after the third candle, huge, took out the downtrend line, we went up very fast. From a technical perspective, the standard deviation, or the distance traveled from the 50, 30, 34 and the 50-day SMA to where we were up here, is rather elevated, seriously overbought. Okay, just the way we were down here, we're probably a -5 on the standard deviation. This was, in my opinion, like a +7. So we definitely got very overbought. Reversion to the mean simply means that it's going to reset. Some profit taking is going to come in, and the reversion to the mean should bring us down somewhere in the 25.75 level, like I said, 20 and possibly a retest of the 50, 34, and the 50. One word of warning, and this is for newer people who don't quite understand technicals. If we break the 34 and the 50-day moving average, it is going to be one of these, okay? It is going to be generally a downtrend, where you're going to keep on trying to the 34 and the 50-day moving average act as a magnet, right? Those are the highways that the cars are traveling in. You move too further away from that, in other words, just like this, the big sell-off before the elections, and you get a very, very oversold condition. Shows up in the stochastics. But you want to stay above the 34 and the 50-day moving average in order to continue with the uptrend, period. It's as simple as that. You want to stay above the 34 and the 50-day moving average to continue your upside move. Otherwise, if you fall below that, and this is going to keep on acting as support, and you're going to keep on losing ground till it breaks out over it again. Let's see what happens. There are some geopolitical issues and stuff that's cropping up, and the markets are overbought. So it's time to exercise caution, in my opinion. I am not an Armageddon type of guy. You know that all. Let's move on to the next video cast. Thank you for listening.